Let me now bring on board Mr. U.R. Bhatt, Managing Director with Datland Capital Advisors. Mr. Bhatt, good morning. Thank you for joining us. Mr. Bhatt, if I map how Indian markets have moved from middle of May, suddenly Indian markets are outperforming not only regional markets, but they are outperforming developed markets as well. So what has changed?
Well, there's a lot of optimism about incremental movements expected in India, as also even in Europe there have been some movement on the in the right direction, thanks to the meetings that heads of state had about a couple of weeks ago, and followed with the finance ministers meet last week. So all this has generated some optimism about some solution being found for the bulk of the problems there. But I think these are all interludes that we have seen of some band-aids being applied for a disease which really requires surgery in Europe. And in India, of course, it is just still a lot of hope only that is there that you can see. There's nothing really that has come on the ground, but lots of expectations about things that could be done in terms of resource allocation, in terms of fighting the balance of payments problems that we have, also in terms of fighting inflation and interest rates.
Mr. Bhatt, the government has about 30 to 45 odd days till the monsoon session to take concrete steps. Should the government fail to deliver this time, can we see a big bout of disappointment for equity markets and thereby a sharp correction?
Well, that's always possible. I mean, that could be on the anvil, because you have monsoons that have pretty much failed, 25% below normal, and I think even in some circles the word drought is being used. So therefore, if that is the case, then the only thing that has been keeping this economy going has been consumption. Investment, of course, has taken a toss. So therefore, I think if consumption is something that's going to be affected because of the depleted monsoon, then I think it's quite difficult to think of a situation where we will have robust growth, or even we could even conquer inflation, because inflation is going to be really affected by food prices and the lack of purchasing power from the rural consumption side. I think all these things are going to have an effect, but as of now it is still a lot of expectation, a lot of hope on the policy front, and that is what is driving markets.
You've used the word hope 5 or 6 times already today. So looks like markets are only running up on hope.
Well, hope plus you have after sort of February, we have for the first time we have seen FIIs pumping in about $1 billion this month. So that is something that has also added to the hope. So therefore, there is a possibility that if this sort of flow of funds from international investors continues, that is again juxtaposed on hope that emanates out of on the policy front. And so therefore, there is, as you said, there is this window of opportunity for the next few days when the government can deliver on that hope, at least partially. And then I think that builds its own momentum. But there is always a possibility that the government might falter, might not be able to deliver on the optimism that is there, and then things could be back to square one.
How are you approaching consumer names? Consumer discretionary, consumer staples, that has been a resilient trade so far for this year. Do you think that trade is now reversing?
Well, not yet, because unless there is a huge movement or potential movement elsewhere, people are not going to sell out of consumers and stock up elsewhere. But the fact is that they will probably produce the best sector-wise results in the June quarter. They are of course not cheap at all. But the point is that if rainfall is going to be very scanty and we have a situation where the rural purchasing power is going to be affected, then I think people will probably change their outlook in terms of earnings growth numbers for these consumer stocks, and therefore there is a possibility of some correction going ahead if we end up with very scanty rainfall.
How would you approach IT stocks now? Now the street is clearly divided on what Infosys and TCS will declare tomorrow.
Well, I think they would be probably one of the better performers in terms of this sector performance among very many others where there might be problems. But because they are the ones who are don't have too much of borrowing, and I think the MTM sort of mark-to-market losses for those who have got a lot of forex loans, that is going to be quite a big sort of event this quarter. But barring that, IT doesn't get affected by that. Plus, of course, the depreciation of the rupee might have helped them to some extent. Even though, of course, the slowdown in the growth markets, in the developed markets, is going to be affecting their fortunes, their guidance might be affected to that extent, and quite a lot of them have lots of cash. So therefore, they have to come up with a credible idea how they're going to use this cash. But in terms of earnings growth, I think they will probably give a reasonably good account of themselves tomorrow.
Mr. Bhatt, what about the banking pact? Because the street is somewhat divided. What's the case according to you? Do you think the NPA overhang is here to stay, or do you think there could be some positive surprises which we could see in the first quarter?
There could be positive surprises, especially from the private banks. Private banks, I think, would be able to present a very good picture, because they have reasonably good growth in earnings, and they manage their credit quality, dramatically better than the public sector banks. Public sector banks also might have a reasonably good growth in earnings, but I think the credit quality and sort of restructured assets, that would be probably something that would be somewhat of a disappointment. So therefore, the market might take a rather dim view about public sector bank results, but the private sector banks will continue to do well.
So if you crudely divide your portfolio into three pockets, how much of your current portfolio has a defensive bias, how much of your current portfolio has a momentum bias to an opportunity bias, and how much of your current portfolio is hedged or is in cash?
Well, I think the growth bias has to be there, whether it is because you have to invest in equity. So therefore, I think things like private sector banks, ITs, the consumer pack, and pharma, these are the ones that probably you would be invested in. Plus also, if the government does make some movement in terms of policy changes, I think infrastructure is the one where they would tweak first. And so therefore, there has to be some allocation to the infrastructure stocks, which are likely to be the biggest gainers if there is a change in policy. So therefore, this is how you would probably distribute your portfolio. Plus, of course, you need to have some amount of cash just to ensure that you keep your powder dry when dramatic changes happen on the policy front or elsewhere. So therefore, I think that's how the general distribution of the portfolio would be.
What about autos, Mr. Bhatt? Because there have been concerns in dwindling sales volumes. The SIAM report has indicated that perhaps it is going to be the two-wheeler majors which are going to outperform the CV as well as passenger vehicle market.
Well, I think in terms of auto, the preference would be largely for the two-wheeler pack. But I think they are the ones, they are experiencing some amount of slowdown, but at least a couple of them are quoting at quite low valuations, and even with the sort of stunted growth, I think they present good value. So therefore, I think auto stocks should be certainly there in the portfolio, and there is probably a case for a mild overweight stance also there.
Mr. Bhatt, but the bottom line here is that Indian markets are up by about 10% plus from their May's low, despite a broken down currency, despite a tricky macro environment, and the fact that Europe and China, these two major geographies, are still uncertain. Do you think the outperformance is some kind of an indication that in the near term we have genuinely bottomed out?
Well, I think people have to be bottom up, because as I said, this 10% move really represents a lot of hope, and that there's a pot of gold at the end of the policy sort of front. So therefore, I think that is, I mean, there would certainly be some movement on the policy front, but not as much as this rally suggests. So therefore, one needs to be somewhat circumspect on that, and needs to be somewhat hedged against a potential sort of failed outcome or a milder outcome on the policy front.
Mr. Bhatt, what about oil and gas? Because consensus on the street believes that that is going to be the most disappointing sector in terms of the first quarter earnings. Do you think that is a fair estimate?
Well, that's a fair estimate, because on the oil and gas front, the chemical margins have been quite lackluster. So therefore, that is not going to be helpful as far as results are concerned. And the oil marketing companies, as I have consistently held, they have no business to be listed, first of all, because the profits are decided by Delhi. So therefore, they're not run on commercial lines. So therefore, there is no point in holding them at all.
Mr. Bhatt, so if you have to, let's say, make a portfolio with a combination of large and mid-cap stocks, which you think would appreciate by about 20 to 25% on a CAGR basis for next 2 or 3 years, which are the kind of sectors, stocks or businesses you would like to buy in that portfolio?
Well, the ones which probably can give us the best returns based on some hope about on the policy front is infrastructure and power. These are the two sectors where even a mild tweaking of policy might help in terms of sector performance. So that is somewhere one needs to be invested. Plus, the better private sector banks are the ones that I think one needs to be invested, because they have given a very good account of themselves even during the slowdown. Then, of course, you need to have some amount of the FMCG and the pharma companies and a bit of IT companies. But other than that, there is not really great confidence in any sector. Typically, the ones that are going to be affected by monsoon and by a failed monsoon, plus high inflation and high interest rate regime. So I think these are the ones that one needs to avoid. But the sectors that I highlighted earlier, they are the ones where I think better performance can be expected over the next 1 year.
For those who are buying L&T, BHEL, GMR, GVK with the hope that power sector reforms are around the corner, do you think they could be in for some disappointment? Because so far what we've got from New Delhi is only talk.
Well, there's more and more talk, but at some time they need to deliver on the talk. So therefore, I think the EPC companies are not the ones that are going to be changing their fortunes dramatically just by an announcement. But I think the outlook on the power companies might actually change if there is some progress on the resource allocation front and in terms of recasting the finances of the electricity boards, because these are two big events that can change the fortunes of the power companies.
The power space into 2 or 3 large subsectors. First, pure utilities, companies like NTPC and Tata Power. Then you've got pure merchant power companies, which companies like JSPL and Jindal Energy. And then you've got power ancillary companies, names like PFC, REC and Power Grid. So within the power sector, which particular subsector you are bullish on, you are hot on?
Well, I think the power utility companies which have got the projects sort of stalled on account of the policy problems, they are the ones which will probably have the biggest delta if the policy changes. The power ancillary companies that you mentioned, I don't know whether they will have an immediate effect on account of changing policy. But I think the power infrastructure companies which have got their projects that stalled, or on account of huge outstandings for the electricity boards, where electricity board financial recast can help. These are the ones that I think that will provide the best delta.
Mr. Bhatt, do you think an incremental diesel hike as well could be a positive move at this juncture, and any steps to reduce the fisc are going to be taken extremely positively by the market?
Well, they'll be taken extremely positively, because even the hope of something like that happening, we have had a 10% run. So therefore, if they actually deliver on that, I think there'll be an absolute celebration in the market. But I think that waiting time cannot be too long also, because something needs to be delivered and hope has to be sort of delivered on. And if that doesn't happen, there could be a reversal.
What about the central bank action though? Would you be surprised if the RBI were to cut rates this time around?
I'd be dramatically surprised, because hearing the noises that are coming out of Main Street, as also the fact that inflation seems to be stubbornly at higher rates, there is really no case for interest rates to be cut. And so therefore, if they really cut, then I think that's a huge surprise.
Mr. Bhatt, so if somebody gives you $1 million to invest, you are in the business of money management, that $1 million which you receive, let's say next 10 or 15 days, how would you invest it?
As I said, it would be quite largely distributed among the sectors that I mentioned. That is, infrastructure, power companies to a certain extent. Then you need to be in IT, private sector banks, and of course a bit in FMCG and pharma, plus a bit of cash. I think that's how one would need to allocate this, and probably ignore most of the others.
Do you think private sector banks are running ahead of their times? HDFC Bank is now trading at a price to book of something like 5 times, which is not expensive, but I would say wildly expensive.
Well, yes, of course, that particular name is very expensive, but there are others which are not as expensive, but probably hold as much promise. So I think they are the ones one should be banking on.
So what do you like within the banking space?
As I said, private sector banks,
It's a large definition.
the less expensive one.
It's a very large definition. I can think of 25 names, you can think of 30. Let's nail it down to 2 or 3.
No, there are old generation private sector banks and new generation private sector banks. Probably the new generation private sector banks which are less expensive.
Let me think, Mr. Bhatt. I cannot think and zero it down to a single one. Maybe you'll have to help me because I'm still thinking hard.
No. I have zeroed it down to just a few names, and therefore I think that's very easy to guess.
Where do you think this market is offering deep value for someone who's a genuine value investor, is ready to digest a 15% volatility, a 10% downside? Because power sector banks, consumer names, these are well-defined and well-discovered stories. What are your contra bets?
Well, as I said, the power sector is a huge contra bet because they are really in the dumps, and I don't think, and the way it's going, they would probably be ending up on the CDR queue quite soon. So therefore, there's a huge contrarian bet because that juxtaposes dramatic action from the government. And my take is that the government cannot postpone these decisions for too long. So therefore, that's a bet worth taking. That is the big contrarian bet I think is worth taking.
So what do you think is going to be the most positive pocket this earnings season that one needs to look out for, besides banks, of course?
Well, even IT companies might give a reasonably good account of themselves. Plus, you have, even the public sector banks on the earnings front, they might be fine. But I think it's just on credit quality that they might disappoint because there will be a huge amount of restructuring and NPA increase. So that is the one needs to guard about. But otherwise, it is IT, it is financial services. These are among the bigger sectors. These are the two that can probably do reasonably well. And even auto might not be a bad bet at all, especially some of the better names. They might actually give a reasonably good account of themselves.
You also run a long-short portfolio. So in your long-short portfolio, what's the bias?
Well, a long-short portfolio has to be necessarily somewhere near neutral to the market. So therefore, it is just you're exploiting pricing sort of aberrations within stocks in the sector. So I think that's a different ballgame altogether.
Maybe I phrased my question incorrectly. In your long-short portfolio, where are you long and where are you short?
Well, I think, as I said, it is in particular sectors where you are bullish, you tend to be long, and you need to sort of make it market neutral by taking short bets on those stocks which you're not very bullish on. And generally, the sort of sector allocation that I mentioned, the ones which I not mentioned, they are the ones where one would probably need to go short to hedge your portfolio.